Depreciation methods of depreciation. Fixed installment method. This method also known as straight line method. Under this method, a fixed proportion of the original cost of the asset is written off every year. It is simplest method of depreciation. The amount of depreciation chargeable is constant from year to year. Reducing balance method. Under this method, depreciation is charged at a certain fixed rate on the reduced balance of the asset every year. Book value of the asset is brought down each year, and on the residual value, depreciation is charged at the fixed rate. In this method, the amount of depreciation goes on diminishing as the year progresses. The annuity system. Under this method, the interest is a fixed rate is calculated on the capital outlay expenditure in the acquisition of asset on the assumption that if the same amount of capital is invested in some other investment, it would have earned a certain rate of interest. This system is based on the assumption that on utilizing the asset, not only the original cost of the asset is reduced, but also thereon is lost. The amount of to be thus written off will be ascertained from the depreciation annuity tables. This method is usually mainly in respect of long leases, which generally involve a considerable expenditure. Depreciation fund method. Under the first 3 months, however, ready cash is not available. When the time of replacement comes, the amount of depreciation may be dispersed in some other way, making it difficult to find ready cash to buy a new asset in the place of the old one. The depreciation fund method ensures that when replacement is due, ready cash will be available. In a nutshell, the system is that the amount written off as depreciation should be kept aside and actually invested. When the life of the asset expires, the investment are sold and a new asset is purchased with the sale proceeds. Insurance policy method. The basic difference between the depreciation fund system and insurance policy method is that whereas as under the former investments are purchased, under the latter an insurance policy for the required sum is taken out. The amount of premium is paid every year. At the end of the given period, the insurance company will pay the aggregate amount with which new asset can be purchased. Revaluation method. This method of depreciation is used only in case of small items like cattle, stock loss, loose tools, etc. The amount of depreciation is ascertained by comparing the value of the end of the year with the value in the beginning. The difference after revaluation is charged as depreciation to profit and loss account. Machine hour method. Instead of estimating usual life of the machinery in years, it is estimated in hours. Then an accurate record is kept regarding the number of hours each machine has run, and depreciation is charged accordingly. The depreciation rate per hour is arrived after dividing the original cost of machine by the estimated hours for which machine is to be utilized. Depletion method. This method is used in case of mines, quarries, etc. In such cases, the estimated total quantity of output is ascertained and depreciation is calculated per ton of materials extracted from quarry or mine. Depreciation is a gradual, continuous, and permanent reduction in the value of fixed asset due to its wear and tear, due to its constant use, and such other similar cases. Depreciation represents permanent decline in the value of assets arising through wear and tear from the use of those assets in the business. Necessity of providing depreciation. Provision of depreciation is necessary for ascertaining true profits. Secondly, the retaining funds in the business so that assets can be replaced at the proper time, and thirdly, for presenting true and fair view of the account. Depreciation is not visible expenditure, as actually cash do not go out of the business. The loss arising by way of depreciation is over and above the amounts expended annually in respect of repairs and renewals, which are necessarily to maintain these assets in working condition. Features of depreciation is charged on fixed asset only. There is a fall in the value of fixed asset. Such fall is gradual, continuous, and permanent. Causes of depreciation: passage of time, amortization, depletion, obsolescence, fall in market, factor determining amount of depreciation, cost of asset, life period of asset, residual value. Now the receipt and payment account. Receipt and payment account is containing income and expenditure account. Then balance sheet. Income and expenditure account, debit side, credit side. Salaries, printing stationery, telephone, gardening, cricket, insurance, expenses. Then credit side, subscription, entrance fee, receipts, interest, by sundries.